Hi, this is Shupriyo, and today we are going to find out why the RBI does not pay interest on the CRR. Can you believe that earlier RBI used to pay interest on the CRR? And what if I told you that it took 20 years for the RBI to realize that this is a bad thing? So today what I'm going to do is cover a bunch of things like should the CRR be abolished? This is something that Pradeep Chaudhary of SBI used to say. We'll also go into why the CRR is so important for our economy. And then we are going to go into the historical aspect of CRR and why we had earlier paid interest on it and now we have stopped doing that. So I got this question from a lot of you out there, and even I had this question a few years ago, but a legendary man cleared it up for me. S.S. Tarapur. This man, who was the former deputy governor of the RBI, has written amazing books, and because of him I was able to understand this concept so well. And may his soul rest in peace. The man was a legend and an extremely well-versed economist. So let's begin with why SBI chairman, the erstwhile SBI chairman, Pradeep Chaudhary, had said that CRR should be abolished. So this is something that happened at the beginning of the last decade, and many of you might not be knowing about this. However, the RBI interview panel can put this question to a lot of you, so it's quite important that you know about it. So it was not only Pradeep Chaudhary who said that the RBI should abolish it. It was even K.C. Chakrabarty. So he was actually a former deputy governor of RBI, and he had been heading Indian Bank before he had joined the RBI. So even he was a bit convinced, and even the government was a little bit convinced about the arguments that Pradeep Chaudhary had put forward, and the RBI was very unhappy about it. So what Pradeep Chaudhary actually said was that since CRR does not pay any interest, it is a huge loss to the banks. So if this is abolished, the bank's income will shoot up. So it's one of the reasons why he wanted it to be abolished. Then he also said that why should banks only deal with the CRR and not the mutual funds or the insurance companies? Why do banks only have to shoulder the burden? Now I'll just answer a little bit about each of these questions. So for the first question, the main answer is that it will lead to a huge amount of inflation. If we suddenly let go of so many funds, then the inflationary aspect will be monumental. I'll just show you something that I dug up. So take a look at this picture. This is the latest money supply figure that has been released by RBI. It was released in January of 2020, and this is the figure that I worked with. So pause it and study it if you want. So as per this figure, the total NDTL of the banking system as of November of 2019, it was around 137 lakh crores. So it was this figure, 137,40949 crore. So 137 lakh crore was the total NDTL. So if you just do a rough estimate, since CRR is right now 4%, so 4% of this figure comes out to be 5.5 lakh crore or rupees 5.5 trillion. So if the CRR were to be abolished, this 5.5 trillion rupees will be released into the economy. So can you imagine the amount? This is even higher than the telecom dues, which is just a little bit like it's even lesser than 2 trillion, right? The telecom dues that we talked about, the AGR case. So this will cause a huge amount of instability, and even the banks will not be knowing what to do suddenly with so much of money coming into their hands. And the next thing, that why should banks only deal with the CRR and not mutual funds or other insurers? Well, the reason for this is that their regulators, the regulators of insurers or mutual funds, they do not create money. So they do not deal with money that has been created out of thin air, like the bankers deal because of RBI. So the money that is kept in the banks, it is even more sensitive, and banks play a very important role in the economy as a whole. So basically there are a lot of issues with the liquidity management of a bank. So if you suddenly say that since MFs and the insurers are not paying, but we have to pay this because it is kind of a cost, right? When you are putting money idle, it is as if the bank is paying something. It's having a cost that this money is sitting idle. So you cannot directly compare these two entities. Like you cannot compare mutual funds with insurance companies, and you cannot compare these with the banks because they are separate institutions and the balance sheets of all these organizations are different. So you cannot compare apples to oranges, right? It is a very silly comparison and does not hold any ground. And another thing you have to understand is that this CRR, it was recently not much used by the Monetary Policy Committee. So basically back in December of 2018, people had expected that the Monetary Policy Committee, they will be cutting the CRR value, not only the repo rate, but the CRR value might also be cut. But at that point of time, in a press conference, Urjit Patel was asked, why have you not cut any CRR rates? So at that point of time, he said the CRR decision is not under the ambit of the Monetary Policy Committee. So understand the gravity of this statement. This means that even the governor of the Reserve Bank understands that we cannot go ahead and willy-nilly just go and cut CRR because it has a very important aspect and it is not something that the MPC can tamper with. So moving on, there is another thing which is quite important to understand, that CRR is very important for the liquidity cover of the banks. So what do I mean by the liquidity cover? How does this aspect come into play? I'll show you. So basically when we are talking about reserve ratios, in the last video we talked about reserve ratios. So go ahead and watch that if you haven't watched it yet. It's quite interesting. So when we talk about reserve ratios, not all the reserve ratios are equal. Basically, we have two types of reserve ratios. We have the CRR, which is the cash reserve ratio, and we have the SLR, which is the statutory liquidity ratio. So on the CRR, the bank cannot earn any interest. You already know this. This is the main subject of this video, and it is maintainable in the form of cash. So how does the bank maintain this? It's basically in a current account with the RBI, because nowadays, of course, nobody will be going with truckloads of cash and depositing it in the RBI. That doesn't make sense. So basically there is a current account that is kept with the RBI, and in this current account there are transactions done and the CRR is maintained in that account itself. And what about the SLR? So the SLR, which is about 18.25% at this point of time, it can earn interest and it is maintainable in the form of liquid assets like gold, bonds. So it's not mostly gold, it's mostly going to be bonds, and this thing is maintained with the RBI in something called the RCSGL. So what is the RCSGL? It is the repo constituents subsidiary general ledger account. So this account is something, you can think of it as a demat account of sorts, because the bonds, all the transactions of the bonds between the RBI and the bank, they happen in the RCSGL account. So that's all about the CRR and SLR and the differences. Now we come to the liquidity cover thing that I talked about. So CRR, it is basically used for the short-term liquidity cover. Remember this, CRR helps for the short-term liquidity cover. So any kind of liquidity crisis that happens in the short term, it can be solved by CRR. That's why it is kept separate. And what about the SLR? So SLR has a short plus medium term liquidity cover. So SLR covers both the short term liquidity and the medium term liquidity. Now, another thing you have to understand, that SLR has some securities that cover very short term liquidity as well. Now, what is the very short term liquidity? It's something like within 30 days or even shorter than this. Now, you have to understand that these two, CRR and SLR, these are the reserve ratios that we are using in the Indian economy. But in the international economy, they have come with Basel norms. Now, we'll not go too too much into detail about the Basel norms. So you already must have read about the CRR, the CCB, the CCYB, etc., etc. So these are the other kinds of things. I'll just tell you the main difference, and because some people might be thinking, okay, so the Indian economy needs to maintain CRR, needs to maintain SLR. Now why are we going ahead and we are maintaining the LCR as well? We are going to maintain our capital base using all of these things. So why is this important? There are basically two kinds of ways in which the banks are funding and they are actually conducting their business. So it's basically the liability side of the balance sheet and the asset side. So we go back to the balance sheets. So it's always important to think of all of these things in a balance sheet way. It helps you conceptualize everything. So just understand what this CRR, this LCR, what are these things? These are all things that come under the asset side of the balance sheet. So everything CRR, SLR, LCR, these are all dealing with the asset side of the balance sheet. And this Basel norms of CRAR, CCB, these are what? These are capital, dealing with the capital of the bank. So they deal with the capital base of the bank, and they are something comprising of the liabilities side of the bank. So understand this. This is something that is crucial to understand. You cannot go ahead and substitute these things with that. Okay, because you are dealing with different sides of the balance sheet. Now, Indian banks, our capital base is not that good. We do not have that much good capital. That is why we are struggling to maintain all of these Basel things, these Basel norms that are in the news. You will find that many banks are having a lot of struggle to maintain their Basel norms at the correct level. So this is all dealing with the liability side of the balance sheet. What the Indian banks do, they basically go about their business by the asset side of the balance sheet. So we have deposits, which are our funds, sources of funds, and those deposits we go ahead and lend as a loan. So we are only dealing with the asset side. So we need to strengthen the liability side of our balance sheet, and that is where all these Basel norms come in. Now, I hope you understand the distinction between those things. Now, the LCR, or the liquidity coverage ratio, this is something that was mandated in the Basel norms. Okay. And so the LCR also deals with short-term liquidity. Okay, so LCR, this is something that deals with short-term liquidity. So since it deals with the short-term liquidity, can't we try and club it with the SLR or the CRR? With the CRR, we cannot, because that does not have any interest, and CRR is not maintained in the form of bonds. Remember this. So what the RBI thought that, okay, these banks, they are having so much of burden. Let us do one thing. So you use a portion of your SLR securities to compute your LCR. And this is why we came to the fall CR. So what is the fall CR? It is the facility to avail liquidity for liquidity coverage ratio. So it's a very, very big name, but it is a very, very simple concept. The concept is, I'll just read it out for you. A percentage of government securities within the mandated SLR as HQLAs, high quality liquid assets, for calculating LCR. Now you have heard about HQLA. So what is HQLA? It is high quality liquid assets. There are basically two types of HQLA. There is HQLA1 and there is HQLA2. So HQLA1 is the more important part. It's the more liquid part. And RBI told, okay, since HQLA1, HQLA2, all of these things are inside your SLR things. Okay, these are all inside SLR. So what they told, you take a portion of your HQLA1 and you can use that for computation of your LCR as well. And this is called a carve out. So basically this 18.25% of your SLR, this thing, from this portion, you can carve out this 14.5% of HQLA1 assets to compute your LCR. Now the carve out was actually 14.5% till now. It's going to be 15% from April 1 of 2020. I hope you understood. Why am I explaining this to you? So that you can perfectly understand why we are doing all of these things. You need to understand, to conceptualize, because these things are not covered in books. They are not covered anywhere else on the internet. And even I had a lot of trouble understanding those things. I had to go ahead and read BIS papers and all of the very heavy things that RBI releases. So I have simplified this down to you. If you want me to make another video on these things, tell me later on. So let's go ahead to the next part. So now we will come to what used to happen earlier. So earlier, what used to happen from the 1970s to the 1990s, we used to have interest on the CRR. As I told you, we used to have interest on CRR. So it was about 5% in the 70s, and it went ahead and they increased it. So it became 10.5% in the 90s. Now, can you believe it? We used to have the interest on CRR. Now you must be wondering, what the hell is happening here? Why would RBI go ahead and pay interest on CRR when it's not mandating that right now? So why did they used to do that? Understand the historical significance. Like whenever all of these things happen, they do not happen suddenly. These happen over years and years of experiences. People learn these things over years and then they implement it into policies. So understand this thing. These things did not happen overnight. I am giving you a big, wide recap of the events that happened over decades. All right. So at first, what used to happen, since the banks did not earn on CRR, the notion was that this is the reason that they are keeping their lending rates high. So the RBI thought, okay, so they need to keep CRR. So that's why the banks are not lending at a lower rate. So to lower the loan rates, what the RBI did, they told that, okay, we'll go ahead and we'll increase the interest that we have to pay on the CRR. Okay, so if we increase the interest on the CRR, what's going to happen? The banks are going to feel that, okay, I am getting some money from my CRR holdings that I have, so I can reduce the loan rates a little bit and the common man will be benefited. So that was the logic, that was the thinking. And now we come to the scene of S.S. Tarapur, the man who actually solved this issue, and he was involved in a lot of discussions. Whenever you hear the name S.S. Tarapur, and even if you say this name in the interview, you must remember he was involved in one of the biggest committees on capital account convertibility. So CAC right now is outside the ambit of this video. I'll not go into it, but you must read about CAC and what were his recommendations if you want to use his name. So he was a legend, and I am not saying this lightly. Now, in the 1980s, he was also there in RBI. He was a deputy governor of RBI, and there was a debate in the 1980s on, is it really important to give the banks interest on CRR? Is it really necessary? So what happened was, there were two camps that got formed. So one camp said that the CRR interest rate that the RBI is paying, it must be increased. We need to pay the banks more interest. And the other camp, they simply said, no, you are wrong. We need to make it zero. Now, what happened at that point of time, people did not have access to so much information. So they made a call based on whatever informations they already had. So at that point of time, this camp won. So the people who said that we must increase the interest, they won. What happened after that? After the increase of interest paid on the CRR, the monetary policy tool, the CRR, the monetary policy tool, it was rendered totally useless. Now, why did this happen? I'll show you, but it will require a little bit of maths, just a little. So just imagine that the NDTL in the system, it is 100, rupees 100. So if the NDTL is 100 and you have a 4% CRR, so what is the amount of CRR that the bank will have to pay to the RBI? It comes out to be rupees 4, right? Now imagine that the RBI pays 4% interest on this CRR. So what happens is, you need to pay 4% interest 4% interest on what? On rupees 4, which is the actual CRR that the banks have to keep. So 4% interest on this comes out to be about 0.16 rupees, right? So understand what's happening. As a bank, you have to keep 4% in the form of CRR. You are giving it to RBI. Now RBI says, okay, I have got this. I'll pay you a little bit of interest on this CRR. So I will pay you 0.16 rupees. Now what's happening? So effectively, RBI gets 4 minus 0.16, which comes out to be 3.84. So can you see what's happening? Even though the percentage of CRR that the RBI has mandated, it's 4%, but still the amount that is actually received by RBI is rupees 3.84 only. So it's 3.84%. You are keeping it as 4%. However, effectively, the effective CRR becomes 3.84%. Now, what will happen now? Since this is happening, RBI will have to increase the interest rate that it pays on CRR. So you have to increase it above 4% so that this 3.84, it goes up to go to about 4%. Now, can you understand what happens in this process? RBI is going to increase the percentage of CRR. Remember, this is not the interest percentage paid on the CRR. This is the actual CRR percentage, which was 4%. They have to increase that percent so that they can effectively get 4% because they are paying some money. So that money outflow is going on. So what happened was the interest on the CRR, eventually it became more than the increases in the CRR balance in a year because of compound interest. You can understand what's going to happen because this interest, it's going to be added to the next year and the next year, and it's going to balloon up and up and up. So the RBI at the end was forced to increase the CRR. Like I told you, if you don't increase the CRR, you're going to get lesser percentage as CRR. So at one point of time in the 90s, it was as high as 20%, and finally it settled to around 16.5%. Then what happened? So because of all of the problems that the RBI was facing, they decided that, okay, we are not going to pay a flat rate of CRR interest. So we are going to devise a two-tier formula whereby the portion of the CRR that the bank had before 1990, the balance of that will be paid 10.5%, and the balance figure that is after 1990 will be reduced a bit. So after this tweaking, effectively it came out to be 3.5% interest on the CRR balances above 3%. So the bank, when it kept CRR balance with the RBI, 3% up to 3% of the CRR, they did not get any interest, but above 3% they got the interest on CRR of 3.5%, and this went on till 24th June of 2007. Now what happened in 2007? The RBI Act got amended, and after that it was decided that no interest is going to be paid on these CRR balances. So you understand what actually happened because of the compounding effect. I have written it over here, but I've already explained it to you. So because of the compounding effect, the CRR prescription, it needed to be increased again and again and again. And that is when RBI understood that we are making a mistake. We cannot go ahead and tell the banks that we are going to pay them for this CRR balance, because then the CRR as a monetary policy tool, it's going to become completely irrelevant. So what's the point of a tool like that? And that is why finally they decided after 2007 that there cannot be any interest paid on the CRR. And if we have to pay it, this tool will be gone, and also our reserves will be depleted, because you understand that the RBI is going to pay some money back to the government. Every year they pay a lot of money, like 50,000 crore. Sometimes it's mostly above 30 to 40,000 crores. Last time it was 50,000 crores. So you understand this amount will be deducted a lot if they have to outgo the interest on the CRR balances. So the RBI came to the realization that it is not necessary to pay any any interest on the CRR. Now, you must remember that many countries, they don't pay any interest on CRR, while some do. So it depends on the countries and the economic situation. For the economic situation in India right now, we do not need any kind of interest on CRR balances. And it took the RBI 20 years to know all of these things. And thanks to SS Tarapur, we were able to understand why this is happening and what were the repercussions and the historical aspect behind all of these things. So in the end, just remember SS Tarapur's amazing words that payment of interest on CRR balances is one of the mortal sins of central banking. So you understand, there was this another amazing piece which he had written in a newspaper, and he just said in that the RBI would do well to recall the words of the prophet Zarathustra. He who learns nothing from the past will be punished by the future. Now, as you can understand, we sometimes feel like the central bank is infallible, but we are all humans. We keep on learning as we go ahead in life. And the RBI, as the most important financial institution of India, has learnt so many things. And I hope that in this video, you were also able to learn a lot of things. So just I'll leave you with a bonus. Tarapur had written in one of the columns that if we want to pay interest on CRR, two things will have to come into place. First, the fiscal deficit has to be very low, and second, there must be perfect transmission of monetary policy. As you know, both of these things we are still struggling with in our economy. There is not a good transmission and the fiscal deficit is still quite high. So we cannot go ahead and pay any interest on CRR, and I hope that I was able to explain it to you. If you have any questions or you want to add to this discussion, please leave a comment down below, and please like this video if it has helped you solve this mystery that we were all suffering with. So thank you for watching, and I'll see you in the next video.